Hello guys and welcome back to another video. In this video we're going to see expected question and answers for the topic sale of goods on approval or return basis for the CA Foundation exam. The first important question says S Limited sends out its goods to dealers on sale or return basis. All such transactions are however treated as actual sales and are passed through the day book. Just before the end of the accounting year on 31/3/2016, 200 such goods have been sent to a dealer at 250 each, cost rupees 200 each on sale or return basis and debited to his account. Of these goods, on 31/3/2016, 50 were returned and 70 were sold, while for the other goods, date of return has not yet expired. Pass necessary journal entries or adjustment entries on 31/3/2016. Now, here S Limited has sent out some goods to the customers on sale or return basis. And then all these transactions which happen now were treated as actual sales. So this means S Limited, who has sold the goods to the customer on sale or return basis, has treated the sales as actual sales and he has recorded in the books. So this would come under the category of casually. As we all know, under the category of casually, the goods which are sold are immediately recorded in the books of accounts. So even in this question, they have told that S Limited have recorded these entries. And then, just before the end of the accounting year, 200 such goods have been sent to a dealer. So what happens now is, now S Limited have sold some goods to the customer. So S Limited has sold 200 goods on sale or return to the customer for 250 each. And the cost they have given is 200. So 200 is the cost and they have sold it for 250 each. So this would be the selling price, right? And 50 rupees would be the profit which S Limited would earn. And they have debited his account. S Limited has debited his account. This means that the entry is already passed. So the entry of customer account debit to sales is already passed. In the question, they have clearly mentioned that the goods were sent on sale or return basis and it was debited to his account. So the customer account was debited and the sale entry has been made. So while you're making the journal entry, you don't have to put this entry. Now, in the end of the accounting year on 31/3/16, 50 goods were returned by the customers and 70 were sold, which means 70 goods were accepted by the customers. So out of the total goods, which is 200, 50 were returned and 70 were sold. So the balance of 80 goods, there is no information. There is no information given about the balance 80 goods. Now, looking for the journal entries, for the goods of 70, there wouldn't be any entry in the books because previously they have recorded the entry of customer to sales. They have already recorded the sales entry. So this sales entry includes the goods of 70. So there wouldn't be any entries in the books. But 50 were returned by the customers. So we'll have to put an entry on sales return. and for the remaining of 80 in the year end, we have no information whether it was sold or whether it can return back. Now for this, we would be reversing the sale. So there is no information for the remaining 80 goods. This means that we'll have to take the sale back. The firm has to take the sale back. So first this firm put the entry for customer to sales, and now the sales has to be reversed back as it won't be treated as sales. So we'll have to reverse the sales by putting the opposite entry, which will be sales to customer. So this would be the second entry passed in the books. And the final entry would be recording stock with customer. This would be the third entry. So as we reverse the sale, the stock which was sent to the customer also should be taken by the firm. So we'll have to record the stock which is not sold but the customer holds it. So for that we would be putting the stock with customer entry. The entry would be stock with customer account debit to trading account. Let's start with the journal entries. So the first entry would be, which I told you, will be sales return. So on the year end 2016 March 31st, for sales return, the entry would be sales return account debit to customer account. You can also write as trade receivables. And the amount would be 12,500. So here 50 goods were returned by the customers and the selling price was 250. This would give you 12,500. Now the next entry would be reversing the sales. So on the same date, you'll have to reverse the sales as it is not considered as sales. So for reversing the sales, the entry would be sales account debit to customer account. And we'll have to record this in the selling price. It is very important to know that this will be recorded in the selling price, and the amount would be 20,000. So the goods of 80 goods, which were the balance, was taken as sale or return, and now we have to reverse it for the selling price of 250. This would give you 20,000. The last entry would be recording the stock with customer account. So on the same date, we will be recording the stock which the customer holds and we would credit trading account. Here it is very important to know that stock with customer would be recorded in the cost price. It would always be recorded in the cost price, and reversing the sales, it will be recorded in the sales price. So the goods of 80 will be multiplied with the cost price of 200, and this would give you 16,000 rupees. So in the trading account, this would be shown as by stock sum value, and you will be adding stock with customer of 16,000. So this would be the end of the video, and the second part on sale or return basis will be up soon. Thank you so much for watching, and subscribe if you like the video.